You're watching real money disappear from your account. Not all at once, slowly, trade by trade. And the scariest part? You think you're almost there. 95% of day traders lose money. That's not opinion. That's data verified by financial regulators across more than 12 different countries. And we're not talking about uninformed beginners. We're talking about people who studied, took courses, bought tools. But there's something nobody tells you about that number. The reason most people lose isn't lack of strategy. It isn't bad luck. It's a specific math that works against you from the very first second, and that was designed to look invisible. Stay until the end of this video, because I'm going to reveal exactly how that math works and why it guarantees most people will lose even when they're right more often than they're wrong. Let's start with a simple question. Imagine you make 10 trades. You win 6, you lose 4. 60% win rate. That sounds good, right? Now imagine that every time you win, you make $100. Every time you lose $200. Do the math. 600 in profit, 800 in losses. Final result? Minus $200 with a 60% win rate. That's what the courses don't show you. You can be right most of the time and still be going broke. And there's a very specific reason why this happens to almost every trader. I'll show you in a moment. But first, you need to understand something about how the market was built. The market is not a neutral playing field. It's a system with participants who have structural advantages over you. On one side, you, a trader with a platform, a screen, and hope. On the other side, high-frequency firms executing thousands of orders per second. Funds with access to data you'll never see. Market makers who control the spread, the difference between the buy price and the sell price. And that spread? That's the first place your money goes before you even make a trade. Every time you open a trade, you're already starting in the negative. Not by much, sometimes it's just cents, but add that up across hundreds of trades per month, and you have a constant leak that drains any strategy. Professionals call this friction cost, and that's just the beginning. Now comes the part that will change how you see all of this. There's a concept in mathematics called expected value, and it's the real reason 95% of traders lose. It's not psychology, it's not lack of discipline, it's pure arithmetic. The expected value of a trade is calculated like this. You multiply the probability of winning by how much you win, and subtract the probability of losing multiplied by how much you lose. Sounds complex, it isn't. If you have a 50% chance of winning 100 and a 50% chance of losing 110, your expected value is negative. You will lose money in the long run, guaranteed, even in a perfect coin flip game. And here's the central point nobody talks about openly. Most day trading strategies have a negative or zero expected value. Not because the strategy is bad, but because fees, spread, slippage, and informational asymmetry corrupt the calculation before you even press the button. And there's still a second layer to this story, one that's even more disturbing. Let's talk about what happens inside your head when you're trading. Have you ever noticed that it's much harder to accept a $500 loss than it is pleasurable to make a $500 gain? That has a name. It's called loss aversion, and it was documented by economists Kahneman and Tversky, who won the Nobel Prize for it. The human brain feels the pain of a loss at approximately twice the intensity it feels the pleasure of an equivalent gain. That means you were neurologically wired to make bad decisions in the market. You know what happens in practice? You make $200, you close fast, afraid of losing it. You lose $300, you hold on, hoping to recover. Result, your winning trades are small, your losing trades are large. And that fits perfectly with the math I showed earlier. 60% win rate, negative result. You are feeding the system that was designed to absorb your capital. But wait, there's a third layer, and this is the one nobody in the market wants you to see. Why do courses, brokers, and platforms keep selling the idea that you can be a professional day trader? Because they profit regardless of your results. The broker charges a fee per trade. The more you trade, the more they make. It doesn't matter whether you profit or lose. The course seller charges for the information, regardless of what you do with it. The charting platform charges a monthly subscription, every month. There's an enormous financial incentive to keep you believing it's possible, that you just need one more indicator, one more method, one more lesson. This isn't conspiracy theory, it's business structure. And there's proof of this that few people mention. When financial regulators forced brokers to disclose the percentage of clients who lose money, the numbers were devastating. In some markets, the loss rate reached 82%, 89%, 92% among day traders. The broker knew and kept opening accounts. Now, you might be thinking, but there are traders who make money. How do they do it? This is the most important part of the video, and I promise to show you, so here we go. Traders who consistently profit over the long run have three things in common, and none of them is a secret strategy. First, they understand and control the expected value of every trade before entering it. They don't ask, where's the price going? They ask, given the risk I'm taking, does this trade make mathematical sense? Second, they trade with far less frequency than most people imagine. Retail traders can make 20, 30, 40 trades a day. Consistent traders often make fewer than 5 per week. Because every trade has a cost, and they minimize friction. Third, they have a real, verifiable edge. An edge is a statistical advantage over the market under specific conditions, and it doesn't come from an indicator, it comes from years of data, from understanding when the market has exploitable patterns, and from knowing exactly when not to trade. But here's the hardest truth to accept. For the vast majority of people, the best financial decision is not to try to beat the market. It's to understand that markets are highly efficient and that low-cost, long-term investing outperforms most active traders over decades. That's what study after study confirms, including studies conducted by universities that analyzed decades of real trader data. So why does this video exist? Not to tell you to stop trading, to give you what nobody gave you before you lost your first dollar in the market. The real math, unfiltered. If you're going to trade, go in knowing that friction cost is real, that loss aversion will work against you, that the expected value of every trade needs to be calculated before you enter, that less is more when it comes to frequency, and that anyone selling guaranteed results is selling you exactly what the market never offers. And if you're in the middle of a losing streak right now, thinking you just need to recover what you lost before you stop, I need to tell you something important. That thought has a name: gambler's fallacy. The market has no memory of your past losses. It owes you nothing. Every trade starts from zero, with the same probabilities as before. Trying to recover losses by trading more is exactly what the structures that profit from you want you to do. You made it here, and that already puts you in a different position than 95% of the people who enter the market without understanding the game they're playing. Knowledge doesn't guarantee profit, but the lack of knowledge guarantees loss. Now you know where the money goes, you know why the math works against most people, and you know what separates those who survive from those who don't. Use it, not as a reason to stop trading, as a reason to trade differently, or to make financial decisions with your eyes open for the first time. The market will still be there tomorrow. The question is, will you be in it with more clarity than you had before this video? Only you have that answer.